Hey guys, continuing this series on tax planning, continuing with the what and in the save category. As always, this is not personal, financial, tax, or investment advice. It's just for education. So I want to piggyback on what I said in the last video. So we talked about the employer plan, but in reality, tax planning can go a lot deeper than just defer or not defer in terms of saving your money. As you start earning higher amounts and you're in higher tax brackets, it almost always makes more sense to defer, but you can still get tax-free dollars, and that's to take advantage of what is commonly known as a backdoor Roth. Now, that's not an account type, it's just a strategy, but it's one that I commonly see that is missed. So often, clients are deferring in their employer plan, but they're not also taking advantage of getting some money in on a tax-free basis. So you can still contribute to a Roth IRA, you just have to make a non-deductible contribution to a traditional IRA, and then it's converted, and converted is just another way of saying paying taxes. So you put the money in on a non-deductible basis, you pay the taxes now, you convert it to Roth IRA, it grows, and you do that every year. So not only are you deferring in your employer plan, but you're also getting some tax-free growth in a Roth IRA. That is a great strategy. Now let's talk about on the investment or the brokerage side. So a lot of times people are not taking advantage of the concept of tax loss harvesting. I mentioned this in the first video. So if you own individual securities, you can take advantage of the fact that those sometimes fluctuate in nature. So even if the S&P 500 index goes up in a given year, there's going to be a set number of stocks or companies that lose value. In the event that they do, you can then sell those inside your taxable account, and then after 31 days, you could purchase them back, or you could just buy a similar security, but that is something that's not exact, but substantially similar, to avoid something called the wash sale rule, which will disallow your ability to have losses. Now, why would losses be a good thing? You can actually take the losses, and in a given year, if you have no other gains to offset them in, you can offset your ordinary income up to $3,000. Now, if you're at a high tax bracket, or even if you're in a high tax bracket and this high state tax bracket, that's really beneficial every year. That could be a tax decision or a tax planning strategy. The other thing you could do here is there are ways that you can invest even beyond just the regular tax loss harvesting. This gets into things like long, short equity, etc., where you can accelerate those losses if you know you're going to have a sale later. So there are some things you can do here on the save portion that could be beneficial. Now, finally, what if you just save on a conservative measure? So whether it's a CD or some sort of bond, those also have taxable implications as well. So you need to know, is it a government bond? Is it a corporate bond? Is it a municipal bond? And how are they taxed? Hope that's helpful. I'll see you guys next time.